Hello, everyone. Welcome to the Chris Eyck Show. I'm your host, Chris Eyck, and I have a special guest for you, Bob Bevis. He is a great real estate investor, a mentor of mine, and I have enjoyed the relationship I have started with him throughout my time learning creative financing and other finance well-being lessons learned. So I will let Bob introduce himself and we'll get started.
Hey, Chris, thanks for having me. Super excited to do this interview and share a little bit about my experience to date and any tips I might be able to give your listeners.
Great. Well, really appreciate you taking the time. So let's just dive right in, Bob. How about we do a quick, brief introduction of yourself, your experience, kind of like where you are right now.
Sure.
And your background.
Yeah, happy to do that. So I'd like to say I'm fairly new to real estate, but I guess I've been doing this about 4 or 5 years now, seriously. I was in software sales for almost 25 years, working a W-2 job. And, I have 4 boys, and I did what they told me to do. I went to graduated high school, went to college, got a job, and, continued to work that job. And I worked it for a long time, and I stopped self-development. I stopped learning. And somewhere along the way, I just realized that there's got to be more. And I read the book Rich Dad, Poor Dad and realized, holy crap, I've been doing this all wrong and I need to do something different. And that was in 2019. And I really get started seriously on my real estate journey, which we'll talk more about today. But married for 22 years, 4 kids, and now doing real estate full time.
That's great. I think that'll resonate with a lot of the audience. Just what we hear today, kind of, you have inflation, you have everyone with social media, just, real estate, make $1 million. This is so easy and everything. So I'm excited to kind of dive deeper into that. But, of course, as anything else, it's not always sunshine and rainbows. Now, for your W-2 and everything, was it particularly difficult experience, or were you trying to balance family time and work time? What was that real tipping point for you to really make that jump into, I need an alternate path?
So I guess what I'd share is that, from my W-2 job perspective, when you're in sales, you're only as good as your last month, your last year, your last quarter. And, after doing that for 25 years, you never know. It's like, hey, if things don't work out, if things don't go well, I'm going to be out of a job. And when you're faced with that realization that, hey, if I lose my job, we're in trouble. I have to go get another job. I have to replace that income. And I think, as I became educated, as I really dove into self-education and really learning about wealth, it was, I needed to have assets. I needed to, as Robert Kiyosaki says, an asset's something that puts money in your pocket, not take money out. And that was the realization where it's like, I need to do something different. So I started my real estate journey there, and with the goal of trying to replace a good portion of my income. I was very fortunate to work for a large software company. I had a great base salary. I made a lot of money in commissions, but it just wasn't what I wanted to do for the rest of my life. I've been with that company for 12 years, and they treated me very well. I was very fortunate and very grateful to have that opportunity, but it was time for a new chapter.
Right. Which makes sense. I think that's that kind of that one takeaway I think is super important that I've also found that has helped me is self-development. You can never stop and everything. So that's great to hear. Now, you said 2019 you started this path. You read Rich Dad, Poor Dad. What was your, I guess, immediate next steps after reading that book, having that realization? So from that time point to feeling confident, let's go get a deal.
I don't know that you ever feel confident, right? Going to get a deal.
Loaded question.
Yeah, there's a lot of people out there, right? That they'll analyze and analyze and they'll educate and, and they'll never do anything. So, one of the biggest things is taking action. And so after reading that book, I remember I read that book on a trip out to Vegas that I was going out there for a sales meeting. And, I finished reading the book on the flight back, and I had lunch with a good friend of mine who's a realtor, and he understands the investment side as well. And I can remember, it was a day in October, we get together for a beer and an appetizer, and just said, I'm like, hey, I want to start investing in real estate. And I had already done it in a sense in 2014. I had, I bought another home. We moved, and I ended up keeping that house. So that's really how I got started, but I kind of backed into it by renting my old house. But I didn't do that with intention. In 2019, when I had lunch with him, I said, we need to start looking. And of course, my experience was in single family houses. And so we started looking at single families to see, hey, what's on the market? What can I make work? But when you look at the 1% rule, and for those of you that don't know, you look at the, what the monthly rental income is going to be compared to your purchase price. And if, your rental income is over 1% of that purchase price, it's a deal worth looking into a little bit further. And it became increasingly hard to find deals that even met that 1% rule. In some areas of the country, they talk about 2% rules. Never seen that. I'm based in New Hampshire, and I've been here since we moved back here in 2005. So, grew up in Massachusetts and moved to New Hampshire. Then we moved to Florida for a few years and then moved back. But yeah, so 2019, anyway, we get started, and we started looking at a lot of houses that did make sense. And he called me up and he says, hey, I think I have a good one for you. He had his pulse on, what other agents have coming to the market. And he brought me a single family house, built in 1900. And it was 3 beds, 1 bath, 1 car garage. And it looked like crap, right? The couple that lived in it had not done any any maintenance to the property. I think they had a water leak. There was no ceiling in the foyer. There's holes in the walls. You name it. It just needed a lot of love. So they had listed it for, I think it was 219 initially, and they just kept dropping 10,000. They were divorcing. They weren't on speaking terms, and I think it went all the way down to 167.5 was the purchase price. So he called me up and he said, "Look, I know the seller's agent. This is their bottom number. This is what it takes to pay off their debt. They just want out." And he says, "So this is an easy one. You either want it for that price or you don't." And so we went and looked at it, and I made an offer that day, and for the 167.5, and we get it done.
So that's a couple of things you called out there that I think is important. Looking back at kind of some of the things I think we've learned in the community, like with Pace Morby, the creative financing, understanding the seller, the motivations, and everything, and it seems that it's kind of key in this story. Like, you have sellers that are motivated, they're in a divorce. So here you have them. What is their issue that you're trying to solve? And then from there, you have them keep dropping the price and everything. And you're able to kind of slide in there and take advantage of that.
Yeah. And right time, right place. Right. And it just goes to, it's really having your pulse in the market. I mean, there's obviously a lot of people out here that are doing in marketing the off market deals and doing more creative finance. I really haven't done a lot in the creative finance world. Most of what I've done is traditional financing. We'll talk a little bit more about my journey and kind of how I got there. But obviously their motivation was key to be able to get it at that price. And, we bought it at 167.5. We closed, I think, December 6th of 2019. And I jumped right in. I was still working my software job, but December tends to be a little bit of a slower month. So I hired a painting crew. They painted it top to bottom on the interior. They replaced ceilings. We gutted the bathroom with the exception of the tub. Made that look nice with only 1 bath in the property. Left the kitchen kind of as is, had the kitchen cabinets painted, redid the flooring, refinished all the hardwood floors in it, made it look really nice inside. And then I ended up renting it. I think we had it rented. That was all done, new appliances. And I think we rented it for February 1st for, I think we were getting $2,200 a month for that place. So, with 167.5 into it, plus closing cost, about 170-ish, just over, because I actually bought that cash. And I used my own money. I was very fortunate. I own stock in the company that I work for. I was able to sell some of that stock, convert it to cash. And that was a scary endeavor, right? Like taking $167,500 in cash and buying this. Like I said, it's scary. I think every transaction is scary when you do it for the first time.
Mm-hmm. So that the deal, it sounds like it's a classic BRRRR. I don't know. Did you also refinance to get cash out once you had that rented and up to go?
Yeah, great observation. So it really wasn't intended to be a BRRRR, because I didn't really know what I was doing at that time, aside from, hey, I wanted to buy and hold. I was buying this to rent it. And so I did. I bought it with cash, rented it. And in March of that year, I took out I did basically delayed financing.
Mm-hmm.
I went to the bank and I said, hey, it's rented up. Now, what I learned is that they will only finance up to your purchase price, right? So they would only allow you to cash out. So even though the value, I think the appraisal came in at like $225 when we were done with the interior. But they would only, even though most would do a 75% loan to value, the most cash we could take out in a delayed financing was the 167.5. So I left about 25 grand of my own money, 30 grand of my own money in the remodeling, but I was able to get that initial cash back out.
Mm-hmm.
Put a mortgage on it.
Mm-hmm.
Yeah.
So for the audience, when we say a BRRRR, we're talking about a buy, rehab, rent, refinance, the order of the refinance and the rent. You may be out of order and then repeat that. So here with Bob's first house, like I said, he backed into it, but purchased it bottom dollar for the sellers where they needed to cover the the debt, rehabbed it, rented it, got it up valuation. So that's simple forced equity or forced appreciation he has in there, refinance to get some cash out. And when we're saying then the loan to value requirement there, he said 25%, I think you said was still in the deal. And that's just for the bank's requirement to have some skin in the game, to take some cash out. So now we were able to take a decent amount of cash out, though, still 75% of the new appreciated.
Well, yeah. So 75% up to whatever the purchase price was. So that was a lesson learned, right? So I think if I had done 6 months of seasoning, they would have allowed me to take out 75% up to the appraised value. But because it was delayed financing, I bought it cash. I used a HELOC to fund some of that in addition to the stock. They would only fund and cash out up to what the purchase price was. So that was a little bit of a lesson learned, but it ended up being a great deal, right? I when I did the cash out refi, I got the 167.5 back. So that cash is back. I still deployed 25K of my own money into the rehab. But my mortgage payment was, $1,500 and something bucks, and I was renting it for $2,200 a month. So I was clearing about $700 a month.
Mm-hmm.
And because we had renovated most of the interior, there really wasn't any maintenance items. Now, what was interesting about that is it turned, it really crossed over a lot of different scenarios because it was a BRRRR, but I rented it, and the people that I rented to were building a house. So I knew it was going to be less than a year. We wrote it into the lease that after 9 months, if they could cancel without penalty. However, if it went the full 12 months, they'd have to renew or move. And so in October of that September, they said, hey, our house is ready. We agreed they were going to leave in October. And I said, geez, the most I could rent that house for was $2,300 a month. It made sense to me to say, what can I sell it for? And my realtor said, hey, Greg said, hey, we can list this for, $269. and see what happens. You know, it doesn't cost anything to list it. And so when I looked at it and I looked at the numbers, while they were living in the house, I actually invested. So that cash flow that they were paying me every month, at 700, I used towards painting and fixing up the exterior of the house, new garage door, paved the driveway. So now not only did the interior look great, but the exterior looked great. So when it came time for them to leave, I listed at 269. We got an offer at 273. And instead of keeping it, I'm like, geez, how long do I have to keep it at 700 a month to make 50 grand?
Right.
Right.
Mm-hmm.
A long time. And the potential for things to break and, you know, dealing with tenants. So at that point, I did a 1031 exchange. I was still looking. So that was the first deal I had done. I've done other deals, you know, in March of that year. I bought a 2-family in Manchester, New Hampshire. And then in October, when that was when they were going to be moving out and I decided to list it for sale, I had also just put a duplex under contract. And the closing was supposed to be around that same time, October timeframe. I went back to the duplex and I said, hey, would you be willing to delay closing another 30 days so that I can do a 1031 exchange from this property to that one? So I basically, all that money that I made on that single family, which turned into I guess a flip in a sense.
Yep.
Also brought me into a 1031 exchange. I 1031 all that money, didn't have to put a dime down on the duplex. So all the money I cleared from that single family house really paid for the duplex. So I traded one door for two, playing Monopoly in real life, I guess.
Yeah, no, that's great. Can you tell us what a 1031 exchange is for the audience?
Yeah, so 1031 exchange is something that I had to learn about. And, you know, as we talk about education, but a 1031 exchange is basically an IRS, you know, allowable exchange of like property. So if I take a rental property and exchange it for another rental property, it has to be of higher value. There's very specific rules around it, so I'm not going to get into the legalities about it. Certainly people can do some research on their own, but essentially what the 1031 allows you to do is sell a property, take the gain from that property, not have to pay taxes, and roll, as long as you roll all of that gain into another investment property. So that's what I did. I took all the gain, rolled it over to the next property, was not a taxable event. So I was able to leverage, instead of paying Uncle Sam, you know, however much in taxes, 15, 20 grand on the profit. I didn't have to pay that. I was able to put that money to work in my next deal.
That's pretty powerful. So we have here on this first deal, you went from a burr to a flip to a flip to then to a 1031 to get you that 1 for 2 units. So that's pretty great. Now you mentioned when you were selling this first property, you already had your the duplex lined up. How long did it take you from like purchasing your first property to then be like, this is great, I want to just keep rolling? Like, what was the momentum like? Did you just have another deal lined up from your realtor, or how'd you go about that?
Yeah, so we started with that single family house, and that took me a couple months of contractors getting it rented, and I'm like, okay, now I had my old house with a tenant in it that I moved out of in 2014, and I had this one with a tenant in it, and we continued to look, and at this point in time, we were cherry picking the MLS. He knew what I was looking for, so we continued to look at single family houses, but realized quickly that the numbers didn't work, right? That 1% rule we talked about, it's just like, man, the numbers don't work. So we quickly shifted to, hey, I think I need to go to multifamily. Yeah. And then we looked at some 3 families in the heart of downtown Manchester. And then after doing that, we had to have a conversation. I said, Greg, I need to figure out what type of investor I want to be. This is, and the apartments that I was looking at were not it. So I didn't want to be a slumlord. I didn't want to deal with those types of tenants that come with downtown locations or bad neighborhoods. So we kept looking around, and my next deal was a multifamily, a 2-unit that I did in March of 2020. So only about 4 months after my first deal. And we had that under contract, scheduled to close in March. And of course, that's when COVID hit.
Hmm.
right around that time. And we had one vacant unit that needed to be remodeled. It was actually an owner occupied. So they owned a 2-family. They lived on the second floor, and the first floor was vacant. They had rented it to family members, and they had moved out, and they decided they wanted to sell the 2-family and buy a house. Um, we bought that for, I think, 360, and I used my own money for that deal, right? So I had to come up with 360, 25% down for traditional financing. Luckily, I had great credit. I was making a good income, so I had no problem qualifying for these
Hmm.
mortgages. And but I quickly realized I can't keep doing that. I don't have 110,000 each time I want to buy a $400,000 property
Hmm.
up here in New Hampshire, and that's just the way the numbers were working out. So I did buy that 2-family, and then I'm trying to think. 2020, that was kind of it for transactions there. In 2021, I sold that single family house that I had moved out of back in 2014. And the only reason I kept that was when I bought it in 2002. We bought it for 375,000, and when I went to move in 2014, that was worth 300,000, and we
Hmm.
had put like 50 grand into it. And I'm like, all right, we're throwing a lot of money away if we
Right.
sell this house now. I would have basically been able to walk away with zero, paid off the mortgage, paid the real estate commission, and that was it. We wouldn't have made anything on it. Now, fast forward, I kept that property until March of 21, and I had 4 different tenants over the course of those 6 years, 7 years, and the tenants actually wanted to buy the house. So I did an off-market deal. I sold it to the tenants, and what that allowed me to do was dictate the timeline. Well, I waited. I found a property that was a 4 unit for 525,000, and I timed it to do another 1031 exchange with that rental, the single family house. And with those funds, I ended up buying a 4 unit in March of 21, another duplex with that money in April of 21. And then that pretty much utilized the funds from the 1031. So the 1031, you can exchange into multiple properties. When you sell it, there's just some specific rules that you have to be cognizant of. And then right after that, you talk about scary. I said each one's a little scary. They got easier, as you continue to do them. But I was away at Cape Cod on vacation, and my buddy Greg called me up and he says, "Hey, I have a good one for you, a little outside of your geography, but I had somebody that wanted to invest. So we've been looking at investment properties up in Rochester, New Hampshire." He said they got it under contract. It's a single family and a duplex on the same lot. And he said, "Bob, I walked through it. I know what his number is. He wants 460." And he says, "I'm telling you, this is a good one." And because the duplex was 3 beds, 1.5 baths per side, the house was a 1959 ranch, 3 beds, 2 baths, or 1.5 baths, 2-car garage, full basement, just a really good property. And he's like, "But we got to move quick because the deal just fell through, and I know his number, and he's going to list it again." Um, and so I made an offer sight unseen based on
Hmm.
Greg's input. And I can remember Greg saying, "Man, I hope he likes this."
Yeah.
And it worked out. I still own
Hmm.
that property today. We bought that for 460, and it was a great lesson that I taught my boys. So I mentioned that I have 4 boys. When I started learning all these things in self-development, wealth development, I started what I called basically Tuesday night wealth. And it's really, I invited my 4 boys every Tuesday night at 7 o'clock. I'm like, "Come over, I'll have dinner ready, and I'll teach you some of these things that I learned in my 40s that I wish I would have known in my 20s." And that one I used as a perfect example to say, "Hey, look, here's how you buy with other people's money." 460. I'm like, where am I going to come up with the 130,000 that I need to buy this property when you look at 25% down plus closing cost? Well, I tapped a home equity line of credit, and I used 100 from my home equity line of credit that I already had in place. So the mortgage company put up 75%. Bank of America, my HELOC, put up
Mhm.
another 100, which meant that I had to come up with 30, and that I could do. So I put 30 into it. And when I ran the numbers on it with where rents were and what I could raise them to, I think rents were at 1,200, 1,300, and 1,400. So he's bringing in 3,900 a month between the three units. And I think we raised those to, I think we went to 1,600 initially, or 1,650 on each unit. So it was 32. I was bringing in over 5,000 a month. And when I looked at, my cost between the mortgage, principal, interest, taxes, insurance, and some expenses, it was about $3,000 a month. So I was making basically cash flow of $2,000 a month. And I'm like, boys, what a perfect example of using other people's money. And that was with paying back the HELOC, and the
Mhm.
mortgage was $3,000 a month. I'm like, it's cash flowing $2,000 a month. I'm going to get all of my 30 grand back in what, 15 months?
Mhm.
Yeah. And now I'm into this with none of my own money because I have my money back, and it's an infinite return. And those deals don't come along too often.
Mhm.
I'm glad I bought it. I'm glad I trusted Greg.
So a lot to unpack. I feel like just like listening to the story, a few things come to mind for like a keys to success here. I think the confidence that you kind of got along the way is a big factor. Ability to underwrite and kind of not have the analysis paralysis, and just being able, the numbers work good enough. Like, let me just kind of like execute. Another factor is having an agent or your network that you trust and is kind of like partnering with you. Whereas if you kind of just get one random like agent off the MLS, they may not be aligned or in tune to your goals and everything. But having the that kind of partner with you seems pretty powerful, to just call you up saying, "We have this deal. You can't let this go, and you got to move quick." And then kind of looping back to that confidence there. Okay, let's do it. Numbers work. Just execute. And taking that kind of like quote unquote imperfect action or perfect action, depending on the
Sure.
scenario.
You
It's
got
like
to jump, and
pretty
it's scary every
powerful.
time you do it.
Yeah. Now, if we were to look at that, so 2K kind of cash flowing is huge, amazing. That HELOC, is that a variable rate right now? Like, or like how is
So
that impacted now?
ironically,
Aspect.
I paid that off, right? So that was a HELOC on my home, and I ended up refinancing my home. And when I did that, I lumped the HELOC in, and I just locked it up into a longer term, and so that HELOC ended up getting paid off.
Yep.
Um,
Mhm.
and but HELOCs are a great tool if you know how to use them.
Right.
Right, it's really leveraging other people's money on the equity that you have in your house. Now,
Hmm.
the downside of HELOCs is they are a variable rate in most cases, and there's different kinds of HELOCs. That's a whole nother conversation. But
Hmm.
um, as long as you can invest it and make a spread, it's a great tool because it allows you to control an asset and gain appreciation on that asset, depreciation on that asset, and principal pay down on
Yeah.
that asset using other people's money.
Very powerful. Now, just for the audience, just so who's listening doesn't know what a HELOC is, home equity line of credit. So that's essentially going to be, in Bob's case, a second lien on his primary residence, second lien position, whereas the first lien will be in the initial bank that gave you that 75% funding for your primary residence. Normally comes with a variable rate because it's more risky. That second lien position, as I mentioned, comes with kind of that greater risk for that bank.
So, Chris, I'll add something else. You mentioned HELOC in a second position. There's also the ability to do a HELOC in a first position,
Okay.
right? So the ability to take a HELOC for the right. Let's say you have a $500,000 house, and most of the time the bank wants 20% down, right? And so you're talking about 100. So your mortgage balance would be 400. Well, when rates were low, one of the advantages is you could actually convert to 100% HELOC. So let's say in that scenario, they would give you a $400,000 HELOC, right? 80% loan to value in your house. Forget if you had, imagine it's paid off.
Mm-hmm.
They would give you 400,000. If you have a mortgage, let's say you owed 380 on your mortgage, you could then take that first position HELOC, get rid of your mortgage completely, and now every dollar that you pay into the equity in your home, you have liquid to be able to put to work.
Right.
The downside is it is a variable rate, so you have to make sure that wherever you're investing that money, it's returning a higher rate of return than what your HELOC rate is.
Always, so you can capture the spread between the
exactly. You're just being your own bank using a HELOC.
Mm-hmm. Mm-hmm. I would say I think that's a great tip for the audience. Definitely a level 2 when it comes to HELOCs. Doesn't work in every environment. Very difficult here in this environment, I'd say, for the current rates. But all great tips. Now, when you think of kind of like up until this point in the story, you're now at this one property you have, duplex and a single family. Have you thought of perhaps, I mean, maybe not, but in the environment where you didn't have the tools to have a HELOC or significant cash from your W-2 job to kind of go after a property, have you thought of or have any recommendations of how you would have kind of gotten this deal done?
Yeah, I mean, it really comes down to, right, if I couldn't tap the HELOC for money, it's all about using other people's money. And, HELOC is one form of that, but there's no reason you couldn't find a partner, right?
Right.
You couldn't find a private money lender. So as you gain experience, right, doing these transactions and showing profitable, there's no reason you can't approach family members, friends, your network, to basically say, hey, look, here's what I've done. Here's the returns that I'm getting. I don't know about you, but I opened up my stock account this morning and I was disgusted. Right? It's just the stocks that I invest in, they just, they went down, they've come up a little bit, now they're down again. I have no control over that. So what real estate does, it gives me that control. Now, fast forward, I've actually taken advantage and used other people's money, not to do these deals, but I realized that I needed to scale. I needed to go bigger. And my next, after that last purchase I mentioned, I bought a 12-unit apartment building for 1.5 million. And, I didn't have the $400K to put down to get that done.
Mm-hmm.
I had some of it, but I basically had a list of about 10 people. And the first 2 people on the list that I called, they said, look, you told me if I had a opportunity to bring it to you. And so I'm calling, you're at the top of my list. And if you're not interested, that's okay. I have other people I can call. And the first 2 basically said, I'm in. And one of them was a very close friend of mine. And he used his HELOC. I told him, I said, hey, look, he didn't have the cash, but he had, a couple $100,000 in equity in his house. And I said, look, go get the HELOC. I ran the numbers. I showed him the return. I said, you're going to be an equity partner in this deal. So the distributions paid his HELOC payment. And now that we're stabilized, we've been in that deal since December of 21. Now that we're stabilized, he's getting he was pretty much breaking even for a long time, putting a couple bucks in his pocket, but as interest rates grew up with that variable rate, he was actually like negative $100. Not a big deal. But now he's got, as we looked at the forced appreciation in that property, now the distributions that he's getting, he's actually clearing, $400 a month over what his payment is. And that's free money. He did, right? He didn't put any of his own money in that deal. He went to St. Mary's Bank and said, give me a HELOC on my house. And he put that money to work. And now he turned it into an income.
I think it comes back to the key theme that you kind of alluded to when you first started this journey back in 2019 is getting assets that put money in your pocket. And I think that's just like the classic example, kind of like staying close to what you learned and carrying it through to every deal. And even your friend who partnered with you on the deal. I think that's very, very important. Now I know we're getting close on time here, but I was curious for your deals like that. That was a 1.5, 1.2, you said?
1.5, yeah.
What's your next the current white whale you're going for? Like, what's your next level as you continue to scale?
Yeah, no,
What do you have your eyes on?
well, great question, Chris. So when I left my W-2 job in September 30th of 22, that day I had put an offer in on a 24 unit portfolio deal that was listed at 3.4 million, and we got it under contract at 3.25, and I brought on 5 partners to fund that deal, and that's what I've been working on, pretty much full time, stabilizing that, managing contractors, renovating units. We renovated about 50% of those units, so we have a lot of forced depreciation in that deal. Haven't bought anything in 2023 just due to market conditions.
Sure.
Rising interest rates and low inventory has made it really hard to find anything where the numbers work. So we're kind of sitting back and just waiting. The opportunity is going to come as interest rates go up. I read an article not that long ago that I think it's something like 30% of commercial debt is set to adjust in the next 18 months. So all commercial debt, what that means is you have people that took out loans. The way commercial debt works is you typically only have a fixed rate for 5, 7, maybe 10 years, but most of it's, the standard's 5. So if they took out a variable rate loan at 5 years and they started with maybe a 4%, well, now if rates are 7% and they haven't done a good job of operating that property and they haven't increased cash flow and controlled their expenses, those properties are going to be hitting the market because the deal's not going to work. They're not going to be bringing in enough cash flow to cover the higher cost of debt.
I think it's a very important distinction as we talk about more of these properties and these deals, that you have commercial properties that are kind of another animal in itself and how they're underwritten, and kind of the terms, whereas you may not have a traditional 30 fixed, like you alluded to. You have perhaps anywhere from a 15 to a 20 to a 25 amortized, 5-year fixed, then it goes to a variable. But they also may have some other stipulations where although it's amortized over 25, it may be all due in 20 years or 15 years or whatever,
or 10.
Right? You're kind of at the mercy of the bank at that point for that kind of large funding. I think I read that article too on the Wall Street Journal. So it's interesting how there is going to be this kind of scenario where potentially a lot of opportunity. So now, how are you positioning yourself kind of for that? And if you are you raising like capital at all for that, getting partners in place, like, so you can execute?
Yeah, that's exactly what I'm doing, Chris. Is I'm kind of building my network. It's tough sometimes to build out your network and say, hey, potentially invest with me, but if I don't have a deal right now. So, I am building that network. I've kind of kept it close to the vest. So, a closed network, if you will,
Sure.
of people that want to invest with me. So I continue to build that network, streamline processes, put systems in place to help run my business. I do manage. That was part of what allowed me to leave my W-2 job, is I manage not only my properties, but the partnerships that I've put together. We're currently managing 49 units. So it's been, from, 1 unit back in 2019 when I read that book to now 49 units that we're managing. And we're always looking for deals. I'm always looking and crunching numbers and seeing what fits my buy box. But ideally it's 10 units plus, is, 8 units. It's just the more units, the better the numbers work. And then you can get some good commercial financing. Now, one of the things that I learned, lessons learned, is as I scaled up, it's one thing for me to go out and try to find, 3 or 4 local banks and reach out to them and say, hey, what are you offering for terms? I reached out to somebody that, I'm a big believer in adding value, right? Whether it's something that I can do, so there's another investor that I know that was looking for investors in his deals. And when I don't have a good deal, I still need to put my money to work. So I invested in his deal. And what did that do? It added value to him, but I also became valuable in his network, right?
Sure.
I'm now one of his investors. So I went to him and I said, hey, what are you getting for debt? And he referred me to a mortgage broker. And he said, you're so much better off using a mortgage broker. He's going to charge you 1% typically of whatever the loan amount is. but he's going to shop it with 25 banks in your region. And, he ended up, so in this last deal we did, we got a 30-year amortization on commercial financing, which helps. We got an 18-month interest only period.
Mhm.
And the rates I went to my local bank that I already had a relationship with. Now, this is back in November of 22, and they came back and they're like, oh, we're at 6.25. When I went to the commercial broker, he shopped it with his banks. He got us 5.5% fixed for 5 years. And but the 30-year AM was huge.
Mhm.
And then the interest only for 18 months allows you to get through that stabilization period where you can take a lot of that, the income from rents and reinvest it back into the property. So that's what we've been doing.
That's pretty huge, and I feel like it's just one more thing in kind of like this wheelhouse that you have kind of accumulated of tools, right? So we have, starting in 2019, you're learning like this whole philosophy. You need assets that put cash in your pocket. You're learning these tools and these processes, and that's huge. It's networking. Always network, add value, and then it will just kind of expand what you can use and bring into your own deals. So a lot of great lessons that we've learned along the way. So now, as we wrap up here, what would be your number one thing you'd want to like recommend to the audience, whether it be something that you wish you knew 10 years ago, or just if it's for someone getting started, like what are your words of wisdom here?
Well, geez, there's a lot there, but
Another episode, right?
I would say keep learning, right?
Yeah.
I mean, so many of it. That's what I'm trying to encourage my kids. Like, just keep educating yourself. Read books. There's a lot of knowledge that you can gain from a book that somebody had a tremendous amount of experience over years. They can pack into a book that you can learn in hours. Find a few, really good mentors, whether it's Pace Morby on creative finance or, Robert Kiyosaki and listening to some of his teachings. He's a little doomsday for me lately, but there's just a lot of education in there, and keep educating yourself. And for somebody that's just trying to get into real estate, and I've been telling my kids this as well, house hack, right? Find a way to to get into a property, low down payment, make sure it's a multifamily, rent out the other 2 units, rent out bedrooms if you have to, but get into the game and create an asset. And you don't have to do that forever. That cash flow, you're going to live basically rent free.
Mm-hmm.
And if you can do that, you save that money. Now you have a down payment for your next one. And, if you're young, that's the number one recommendation I would give.
Very powerful. Learn, take action, and keep on expanding your knowledge base. I think is huge. Well, Bob, this has been great. I know we're out of time here, but if people want to learn more about you, connect with you, where can they find you?
Yeah, so I'm just building my brand out. Obviously you can search for Bob Bevis from a YouTube channel. I've also created Tuesday Night Wealth is is a brand that I'm just building out, so they can certainly check that out. I'm on LinkedIn, and certainly happy to connect and learn from one another. That's what this is all about.
Great, Bob. I really appreciate that. I look forward to tuning in to your Tuesday Night Wealth. This has been tremendous help to me, and I hope the audience also takes something away. So really appreciate you taking the time.
Awesome. Thanks so much, Chris, for having me, and this has been a pleasure.
Likewise, Bob.
All
Thank
right.
you.
Take care.